Welcome everybody to this week's edition of Market Insights. Hope you had a fantastic weekend. It was a birthday weekend for me, kind of a big one. And thanks to some dear friends of mine, it was made incredibly memorable. So I was planning on just, going out to dinner with my sweetheart. And unbeknownst to me, as it's time for us to leave, a big black limousine pulls up, picks us up. A couple of friends are already in it. Limo takes us to uh, a hotel where a couple of other friends had flown in to join in the festivities. Um, and this was all kind of their idea. He's a business partner of mine. We go to dinner, and I am presented with a new Rolex watch. This stuff doesn't happen every day, does it? And it was funny. The guy next to us is kind of watching the festivities. And I looked at him and I said, "Did you get a Rolex with your meal?" He goes, "No." I said, "You should have ordered the special." So if your weekend was as 10th as good as my weekend, it was a blessed weekend. So I have so much to be thankful for. Thankful for all of you. By the way, on kind of a side note, I've been approached by a group who wants me to do a weekly podcast. So I think I'll have an announcement about that sometime early next year. So, with all that good stuff, quite the weekend, huh? It is December the 15th. Quick reminder that everything that we do here is for educational purposes only. It is not intended as investment advice. These are simply my observations and thoughts about what's going on out there. So, what is moving the markets? Well, AI related stocks, again, are under pressure. Not a lot, but a little bit. I'm so accustomed to coming on here and talking about tech rocking and rolling. It has been a great year for technology. There's no question about that. But as of late, the big issue is whether or not some of these prices are overvalued, and everything is relative, but things run in cycles. Something is at the forefront for a while, and then there's a pullback, and there's nothing new to that. Now, this is interesting. The Russell 2000 is trading at an all-time high. So if you're not familiar, the Russell 2000 is an index consisting of, supposed to be 2,000, it's just shy of that, stocks, small cap stocks. 40% of these companies don't make any money, but this is what has been leading the charge. And I'll have more to say about the Russell in this report. Non-farm payrolls are expected to grow by 40,000 in November. Big step down from 119,000 the previous month in October. By the way, Jerome Powell is a little fearful as the chairman of the Federal Reserve that we may not be getting accurate employment data. And he said the Fed is concerned that this year we've lost on average 20,000 jobs per month. And that was one of the reasons that we had the rate cut of 0.25% on Wednesday. So just kind of make a little note of that in your mind. I'll be keeping up with this for you, of course, every week. 10-year treasuries steady, 4.182, not much movement there. And oil continues to sink. Boy, oil prices or gas prices are down, aren't they? I'm kind of happy about that. I've got a couple of vehicles that A, take premium, and B, suck it like a wino. So yeah, I'll take this. They're down to 56.77. I think some of the oil stocks, especially with Oil at these prices, pretty attractive right now. Market breadth last week. So you can see the advancers versus decliners. That's the New York Stock Exchange. And this is the NASDAQ. NASDAQ is tech heavy. So the NASDAQ was kind of a push. Um, on the New York Stock Exchange, 1575 to 1256. But I always like to look at number of stocks hitting new 52-week highs versus lows. 344 to 76, decidedly bullish. And then on the NASDAQ, 616 to 306, also bullish. So there's no question. We are still in a bullish market, trending higher. Strong like bull. I wanted to put a personal description in here. But in looking at stocks trading above their 20-day moving average, so this would be a short-term indicator, but almost 70% of all stocks now are trading above their 20-day. Really good short-term momentum. Not so much today, but yeah. So this is last week's heat map. Pretty obvious differentiation, right? Here's big tech, a whole lot of red. And over here, this is kind of the more defensive, right? Consumer staples. And here's industrials down over here and financials. So you could see, kind of depended on where you were. And healthcare has been coming on. In fact, healthcare is the leading sector today, up over 1%, while at the time of the recording, the market's down a little bit. So flipping the script, taking a look at the winners from last week, it was materials, financials, industrials, staples, discretionary, healthcare, and the big loser, technology. But don't freak out. It's just a week, right? And tech was down 2% on the week. Again, flipping the script, earnings growth for the largest stocks versus, or excuse me, the largest 7 stocks on the S&P 500 versus the other 493. So you can sort of see the trend, right? So this is the 7 largest. And then supposed to be the same for next year. And then falling off in 2027. Whereas the other 493, so that's healthy for the stock market. You don't want the stock market to be led by a handful of stocks and a handful of companies that are doing well. Ideally, you want them doing well across the board. And it looks like we're starting to get a little more balance on that. Keep an eye on the Russell 2000. So the Russell was up 9.8% in 9 days. Historically, when that happens, look where the returns go from there. Up 4.8% in a month, 10% in 3 months, 16% in 6 months, 28.9% in a year, and almost 40% in 2 years. Now, that's past performance. It is not a guarantee of future results, but the more analysts I listen to, the more we're talking about the Russell 2000. And I think because it was mostly neglected and as people are getting out of maybe some of the high flyers, the big momentum stocks, where are they going to go with their money? They're going to go looking for value. And right now, that's where they're finding it. So annualized annual realized and bottom up consensus earning per share growth estimates. And check it out. Here's the Russell 2000. Look at that. Right? There's nothing even close. So if this bears out, there's not a guarantee that it will, but if it does, we would expect the rally in the Russell to continue. I thought I'd share this with you. This is mind-boggling. The value of $100 invested in the U.S. large cap stock market index way back in December of 1845, that $100 today would be worth 13 million. Is that insane? Never bet against the stock market. It'll have its ups, it'll have its downs, but believe in American business. It's like nature. Remember Jurassic Park? It'll always find a way. Jeff Goldblum, love that guy. So the Fed, if you listen to the press conference and the statement from Jerome Powell on Wednesday of last week, very optimistic. So, some key takeaways. Here's GDP, right? Gross domestic product, which is the sum total of all the goods and services that are sold in this country. The growth for this year is 1.7%. Next year, 2.3%, right? People ask me about recession. What's the definition of recession? 2 consecutive quarters of negative GDP. Not happening. Unemployment rate supposed to hit 4.5% this year, 4.4% next year, down to 4.2% in 2027. And I'm sitting there thinking, where's the impact of AI? I'm worried about AI replacing workers. The Fed apparently doesn't have that same fear. This might be my favorite. PCE inflation, that's personal consumption expenditure. This is the preferred metrics used by the Fed. And this year, we're going to close at 2.9%, still well above their 2% target. But I think a lot of that has to do with the tariffs that were put on. Next year, that's forecasted to go down to 2.4%. The year after that, 2.1%. And the core PCE, which you take out food and energy because of their variability, from 3 to 2.5 down to 2.1. And then right here, they think we're going to be at their target. So they feel like, everything's moving in the right direction. And as a consequence, watch interest rates come down. So everything about what the Fed had to say indicated a lot of health in the economy. Now, I'm going to tell you something. On a personal level, what I see is a bifurcated economy where the people at the top are doing great and the people at the bottom are kind of suffering because of inflation. Grocery prices go up. It's not like I'm going to stop buying groceries, but what about a single mom or a single dad with 3 kids to raise? I think those are the ones that are taking it on the chin these days. And the winners from last week, Warner Brothers Discovery, of course, they're in merger talks. That's what that's about. Mosaic, Molina Health, Norwegian Cruise Lines. My sister's on a cruise right now. Maybe she's responsible for the increase in the price of that stock, except she's on a different carrier. So we can throw that out. So all in all, pretty decent week. Market sentiment has remained pretty robust. Historically, when independent investors are asked, what do you think the market's going to do for the next 6 months? 37.5% are bullish. Right now, we're at 44.6%. the number of people that are bearish kind of in line with averages. All right, let's check the charts. And here is the S&P 500. So it looks like we got a little bit of a rounded top potentially forming, but there's nothing really new to that. You got it here, you had it here. So basically, after every pullback, for the last 6 months, we have seen a recovery. This cannot be called a pullback. Um, and the key level will be that, level of support, which comes at the 50-day moving average, which is 674. Right now we're at 681. So everything looks to be in great shape. Remember, we generally get a Santa Claus rally the last 2 weeks of the year. So we'll see if that comes to fruition. You never know. But most of the time, last 2 weeks of this year and January are really good for the stock market if you're in the right stocks. So there you have it. I will see you again next week. Until then, be blessed, be safe. Bye for now.